Hey, this is Greg. Welcome to DLA Markets. You know, there's been a lot of talk recently about China and their easing policies and the way that they're implementing all these policies to stimulate the economy. And I've heard a number of market commentators talk about this, Tom Lee, Larry Fink, a couple other people, and they referred to a tsunami of liquidity. And I think this tsunami of liquidity is an interesting topic, so I thought I would talk about it in this video. The important thing is, though, that this is a worldwide phenomenon, I believe, not just in China, but in the United States, with the Fed's recent easing of 50 basis points. And it seems like the Fed is increasingly more and more convinced every day that inflation is under control, and they're starting to ease from the historically high interest rates that they had to combat inflation that they've had for a year or so, year and a half. And so this sort of confluence of events, and let's not forget Europe is also easing. So you have Europe easing, the United States easing, and you have China basically trying to save their economy, which is in a tremendous downdraft, by just throwing essentially a bazooka of easing and liquidity into their market. So we're going to take a look today at how that's going to affect our market, the US market, and i.e. the stock market. I think one thing that's interesting in the mainstream media when you look at how they talk about this China thing, everybody talks about, you know, all the liquidity and the stimulus that China's putting into the market, but nobody actually talks about specifically what are they doing. So I thought I'd spend a couple minutes about specifically what they're doing, okay? So the first thing is they're cutting reserve requirements, okay? Reserve requirements are being cut by 0.5 percentage point, and the main policy interest rate is being cut by 0.2 percentage points, okay? These are larger cuts than have normally been seen in the past, and they're considered quite significant. The second thing is they are cutting mortgage rates, okay? They're cutting mortgage rates for existing home loans by roughly 0.5 percentage point and reducing the nationwide minimum down payment for the requirements for second homes from 25% down payment to 15%. Now, I don't know why they selected second homes for that, but that's what they did. In addition, they're raising funding support for commercial banks from 60% to 100%. So 100% financing they're giving commercial banks to extend loans to local state firms, which are purchasing excess housing inventory and converting them to affordable housing, okay? So that's going to stimulate the economy that way. And the third way that they're providing this stimulus is they are providing enormous structural liquidity to the stock market. They're allowing institutional investors to borrow liquid assets such as treasury securities and central bank bills directly from the central bank and use these assets as collateral and then sell them, be able to sell them to get cash. They need to invest more in equity markets. The central bank will be providing refinancing of loans for banks extending credit to publicly traded companies aiming to buy back their own shares. So in doing this, they're providing a tremendous amount of liquidity, both to the basic economy. They're using this liquidity to stimulate the real estate market, which is completely in the tank. And first and foremost, they're providing an enormous amount of liquidity to stimulate the stock market. Now, when this occurs against the backdrop of Europe and the US also easing credit and easing up on monetary policy, you create a situation that provides a very strong backstop to the U.S. stock market. The steps taken from China this week will unleash a tsunami of liquidity. And as we've said many times on this channel, they say don't fight the Fed. Also, don't fight China, and definitely don't fight the Fed and China together. So I think that says it quite clearly and quite succinctly. I think as you look over the next 6 to 12 months in the stock market, even though we're at relatively high valuations at 21 times earnings, I think these actions by central governments cannot be ignored when you look at how they will backstop and provide support for the financial markets in general, but in particular the stock market. One of my favorite stock analysts, Tom Lee, was recently on CNBC. Take a look at what he said here.
Yes, I think it's part of the formula because, bull markets are supported by strong fundamentals, and this is a case where not only has the economy survived extremely high interest rates, but the Fed is beginning to cut rates. And an economy that has sort of been languishing has been China, and now we have some stimulus and what looks like some bazooka policies that is supporting that region, and we have a lot of cash on the sidelines. So I think that this is a formula for stocks to do pretty well the next 3 to 12 months, and that's why we think that we would be well beyond 5,700 before year end.
Yeah, so with all these things taken together, even though we're nearly 2 years into the bull market, you can't ignore these fundamental factors when looking at the market. And I think even though there'll be some ups and downs over the next 6 to 12 months, I think I'm relatively bullish going into this time period. Now, there's a couple things on the horizon that could disrupt things. One is the election. Depending on which side of the aisle you're on, I personally think that the Republicans and Trump's policies are going to be better for the economy. I don't really even know what Harris stands for or what she's going to do, because every time they ask her a question, she talks about, her upbringing and growing up in a middle-class family where they like nice lawns and shit like that. I don't know what the hell she's talking about half the time. I don't think she's qualified to be president. I wish someone else other than Donald Trump was the Republican nominee, but if I'm just looking at policies and not personalities, I think that Trump's basic policies of smaller government, cutting taxes, and strong foreign policy, I'll go with that every time over this 4 more years of what we had in the last 4 years. But having said that, I think there are a number of geopolitical issues out there that we have to be aware of. The obvious one is what's going on in the Middle East. It appears that Israel is going to attack quite aggressively Iran. Jury's out as to what they're going to do. Are they just going to go after the oil facilities, or are they going to hit the nuclear facilities? Don't wait for Joe Biden to give you permission, because he's completely absent in this whole thing. All he says is, do a ceasefire. Every single thing he says is completely political, so can't rely on him for anything. So Israel's going to have to go it alone, and we'll have to see what they do. But I think fear of an all-out war, I pretty much think we're already there. This is going to add another risk, which is rising energy costs. Even though Iran is only 3 to 3.5% of the world's oil supply, it will cause oil prices to go up, and that is a risk. There's always risks out there, but when you have central banks of the world all singing to the same song sheet, China being the most extreme case, that provides a very strong backdrop to the market, and it's something that we have to take very seriously and monitor it until it changes. Now, if the U.S. Fed sees inflation come back, as may have been indicated by this last employment report, might have been a fluke, but if that trend continues, I'm referring to the strong employment report that we just had. If that trend continues, the Fed might back off and either not lower rates anymore in the near future. Or in an extreme case, if it sees inflation come back, they might start raising interest rates. And of course, that would change the whole scenario. So anyway, I hope you enjoyed this. Hope you found it useful. If you did, please like and subscribe. And I am back in the game here doing long form content, and I hope to continue. So thank you for watching, and I'll see you on the next video.